The silver market is running a structural deficit of more than 200 million ounces, yet the price remains nearly 50% below its all-time high, and that contradiction is not supposed to exist. In 2023 alone, global demand reached approximately 1.24 billion ounces, while total supply struggled to reach 1.00 billion. That gap did not develop over years. It widened in a matter of quarters, not months, not weeks. In less than a year, one of the largest physical imbalances in modern silver history emerged, and prices barely reacted. For decades, analysts said sustained deficits of this magnitude would force immediate repricing. They said modern markets were too efficient for prolonged compression. They said futures markets would adjust. But here we are. Industrial demand is accelerating. Above-ground inventories are shrinking. Sir, the gold-to-silver ratio has surged above 90-1, and silver remains contained in a narrow range. Institutions see this. The data is public. Yet most discussions focus on daily volatility, not structural shifts. What I'm about to walk through changes how this entire setup looks. Because when supply deficits align with historical ratio extremes, the resolution has never been gradual. It has always been abrupt. Welcome to Capital Signal, where we decode what the data reveals before it becomes consensus. This channel exists to examine structural market shifts through numbers, filings, and historical patterns rather than headlines. If this analysis brings clarity, consider joining this growing community of thinkers who value signal over noise. And as always, comment where you're watching from. It's always fascinating to see how global this conversation has become. In 2023, according to data compiled by the Silver Institute, total global silver demand reached roughly 1.24 billion ounces. Mine production and recycling combined supplied just over 1.00 billion ounces. That left a deficit exceeding 200 million ounces, one of the largest ever recorded. Industrial demand alone surpassed 600 million ounces. Solar panel manufacturing consumed more than 160 million ounces, up over 60% from 2020 levels. Here's where it gets interesting. Despite that imbalance, silver traded mostly between $22 and $26 per ounce throughout much of 2023. Meanwhile, gold surged to an all-time high above $2,400 per ounce in April 2024. Historically, silver tends to amplify gold's moves. When gold rallies strongly, silver often follows with greater percentage gains. This time, that relationship fractured. The gold-to-silver ratio climbed above 90-1. To put that in perspective, the long-term average ratio over the past century hovers closer to 60-1. During periods of strong monetary expansion or commodity bull markets, it has compressed into the 40s or even 30s. A ratio above 90 signals extreme divergence between monetary perception and industrial pricing. At the same time, COMEX registered silver inventories fell below 40 million ounces in mid-2023. Just 2 years earlier, in 2021, registered inventories exceeded 150 million ounces. That is a decline of more than 70%. Registered silver represents metal readily available for delivery against futures contracts. When that pool shrinks dramatically, it alters the supply cushion of the paper market. So the central mystery emerges. How can physical deficits expand, inventories contract, and gold break to record highs while silver remains compressed? That is the contradiction. This pattern is not without precedent. In the late 1970s, silver experienced sustained supply tightness amid rising industrial demand and monetary instability. In 1978, silver traded below $6 per ounce. By January 1980, it reached nearly $50. The move did not occur gradually over a decade. It occurred within roughly 24 months. In 2008, during the global financial crisis, silver collapsed from $21 to below $9 as liquidity evaporated. But by 2011, it had surged to nearly $49 again. The pattern followed the same structure. First, compression during systemic stress. Second, a monetary expansion. Third, rapid repricing. In 2020, silver fell below $12 during the March liquidity panic. Within 5 months, it doubled above $24. Massive monetary stimulus and supply chain disruptions accelerated the move. Each cycle reveals the same structure. When deficits align with monetary shifts and ratio extremes, the adjustment is non-linear. In 1978, deficits met inflation. Result, see explosive repricing. In 2010, monetary expansion met constrained supply. Result, rapid rally. In 2024, structural deficits meet record gold prices and industrial acceleration. The ingredients are familiar. Now consider the players. COMEX, operated by CME Group, manages the primary futures exchange for silver. When registered inventories dropped below 40 million ounces in 2023, open interest in silver futures often represented multiples of that deliverable supply. That leverage structure is normal in futures markets. But when physical backing shrinks while paper claims remain elevated, sensitivity increases. Major bullion banks, including JP Morgan and HSBC, act as clearing members and market makers. Public filings show fluctuations in their reported net positions throughout 2023 and 2024, reflecting adjustments to hedging exposure. At the same time, exchange-traded funds like SLV experience periodic outflows, while physical coin sales through the US Mint exceeded 44 million ounces in 2023 despite production constraints. Industrial buyers are not speculators. Solar manufacturers, electronics producers, and automotive suppliers require silver for conductivity and durability. Our photovoltaic demand alone exceeded 160 million ounces. Electric vehicle production continues expanding globally, and silver paste remains a critical component in solar cell architecture. Governments also play indirect roles. Renewable energy incentives in the United States, Europe, and China support solar expansion targets. Those policies translate into material demand. Unlike investment demand, industrial consumption does not retreat quickly when prices stall. Factories continue operating. Timing matters. Inventory declines accelerated as industrial demand rose. Gold broke out first. Silver lagged. That sequencing mirrors previous cycles where monetary perception shifts before industrial repricing catches up. Now the dislocation becomes clearer. Gold above $2,400 signals strong monetary demand. Most central banks have been net buyers of gold for multiple consecutive years, adding hundreds of tons to reserves annually. Silver, while partially monetary, trades with heavier industrial influence. The ratio above 90 suggests silver is priced more like a stagnant industrial metal than a monetary asset. Yet industrial demand is not stagnant, it is rising. Solar capacity installations continue breaking records. Data from global energy agencies show annual solar additions increasing year over year. That creates a paradox. Rising industrial consumption should tighten supply. Instead, futures pricing remains subdued. Another contrast emerges between paper and physical markets. Retail coin premiums periodically widened during 2023 as physical products faced bottlenecks. Meanwhile, futures prices did not reflect scarcity. That divergence indicates segmentation within the market structure. Historically, such gaps resolve through convergence. Either industrial demand collapses, easing deficits, or prices rise to incentivize additional supply and ration consumption. Mining expansion is not immediate. Developing new silver mines can require 5 to 10 years of permitting and construction. Recycling increases marginally but rarely offsets large deficits quickly. Here's the mechanism. Silver pricing is heavily influenced by futures contracts traded on exchanges. When large participants hedge production or speculate on macro conditions, they create liquidity and volatility. Margin requirements, contract rollovers, and leverage structures can amplify short-term moves. Imagine a system where paper claims represent multiples of physical supply. So as long as confidence remains, pricing reflects expectations rather than immediate scarcity. But when physical drawdowns accelerate and deliverable inventories tighten, sensitivity to shifts increases. Small changes in positioning can trigger outsized price responses. Margin hikes have historically cooled rallies. In 2011, CME increased silver margin requirements multiple times during the rapid ascent toward $49. Each hike forced leveraged participants to reduce exposure, contributing to sharp pullbacks. That illustrates how exchange policy interacts with price velocity. Today, instead of margin hikes suppressing a rally, we observe compression despite deficits. That suggests large players are comfortable maintaining positions within range-bound pricing, but compression builds pressure. The longer a spring is held, the more forceful its release when constraints loosen. Cause and effect chain. Industrial demand absorbs supply. Inventories decline. Futures leverage remains elevated. Gold signals monetary strength. Ratio widens to extremes. Eventually, either industrial growth slows significantly or silver reprices to restore balance. Forward analysis must remain conditional. Historically, when deficits exceed 150 to 200 million ounces for consecutive years, prices adjust upward within 1 to 3 years. If gold remains above $2,000 and central bank buying continues, monetary tailwinds persist. If solar demand maintains current growth trajectories, industrial absorption continues. A conservative scenario assumes gradual supply response through increased recycling and modest mine expansion, leading to steady but moderate price appreciation. A moderate scenario assumes ratio compression toward historical averages near 60, implying significant percentage gains relative to gold. An aggressive scenario mirrors prior cycles where deficits and monetary shifts align abruptly, producing rapid repricing. What indicators matter? Watch COMEX registered inventory levels. Monitor the gold-to-silver ratio for sustained compression below 80. Track annual solar installation growth rates. Observe ETF flows and central bank gold purchases. These data points historically precede major adjustments. This is not about certainty, it is about pattern recognition. Those who study structural data see compression as a phase, not an endpoint. Those who focus solely on daily price action see stagnation. The difference is not intelligence, it is time horizon and attention. Information asymmetry creates wealth asymmetry. Institutions analyze supply reports months before headlines discuss shortages. Industrial buyers secure contracts long before retail notices tightening inventories. Futures positioning adjusts quietly before visible breakouts occur. Retail participants historically arrive after acceleration begins. That has been true in commodities, equities, and bonds. Early recognition is rarely dramatic. It is methodical. Silver's story today is defined by contradiction. Record gold prices, expanding industrial demand, shrinking registered inventories, extreme ratio divergence, yet subdued pricing. Contradictions do not persist indefinitely in markets governed by supply and demand. Resolution may come through gradual repricing. It may come through a sudden spike triggered by positioning shifts. Or it may come through macro catalysts that alter monetary expectations. But structurally, prolonged deficits rarely resolve sideways. This is capital signal, where we decode what matters before it becomes headlines. If this connected dots that previously felt separate, you already understand the value of seeing patterns early. The question is not whether compression eventually resolves. The question is whether it resolves quietly or suddenly, and who recognizes the setup before the adjustment begins.